Going on everyone, in today's video we're going to be covering index funds versus mutual funds. Now these two types of investment vehicles have their own unique pros and cons, and the terms are often thrown around sort of interchangeably in a similar context. So today we're going to be trying to paint a bigger picture of the two and see which type is better for your style of investing. Starting off with a mutual fund. This is sort of a collection of securities such as stocks, bonds or cash. This is managed by a fund manager who is someone that has a long-standing history in finance, business and the stock market. They are paid to sort of make the fund profitable for investors, and they allocate the money that they receive and sort of dictate where the money goes from the investors that invest within the mutual fund. With mutual funds, because someone is paid to manage the fund and make it profitable, there is a sort of higher percentage deduction from the money you invest within the fund. Now, regardless if the fund is profitable or not, the fund manager will receive money for the time he's put into selecting individual securities. When you invest within a mutual fund, you kind of become an owner within various types of companies. So when you do one, say, lump sum investment, you become a small part owner in various different stocks or the other securities that make up that mutual fund. So this kind of makes it deemed to be a safer investment as you invest in different various sectors of the market. So if the tech companies are rising in value but the oil companies are declining, they sort of share balance between the two, and there's normally a consistent but slow increase in the value of your investment. And also, instead of having to spend time and do your own research into selecting your own types of stocks, you just pay someone with a long-standing business history and financial understanding to do this for you. Now, there are different types of mutual funds. For example, there are fixed funds which buy exclusively bonds, equity funds which buy only stocks, and balanced funds which buy a combination of stocks and bonds. Now, moving on to index funds. With these, they're essentially a fund that tracks the trend or the changes that occur within the market, and the purchase of the companies that comprise these index funds is automatic. No one is sort of paid to select or dictate what stocks comprise the funds. So for example, the S&P 500 tracks the top 500 companies with the US, and whatever companies fall into that top 500 category, as they change or vary from year to year, they're automatically put within this fund. There's no individual person selecting which companies go into this category. Now, there are different types for different countries. For example, there's also the ASX 500 for Australia, tracking the top 500 companies within Aussie. And then in New Zealand, where I'm from, there is the NZ Top 50. Now, when you're thinking of companies that make up an index fund, think things like Amazon, Facebook or Apple, sort of quite large, big brand companies. But obviously not every company will fall into that category. And the same is with index funds as it is with mutual funds. When you invest within the index fund, you become a small part owner in all the companies that make up that fund, and you participate in all the wins and losses. Now, because index funds are passively managed, there's often a lower brokerage fee or a lower percentage payment required from the investor to participate within the index. So this can be another consideration when picking between mutual funds or index funds. That wraps it up for the video. I hope you found the content useful. If you'd like to see more future videos or learn more about the stock market, feel free to subscribe to the channel for more beginner-friendly stock market advice.